Good morning, everyone. I'm Sharon Fenolio, Associate Vice Chancellor for Advancement, and I would like to welcome you and thank you for joining us for this UMSL Legacy Council Lecture Series presentation, Commercial Real Estate, Fundamentals of Ownership and Investing. I want to cover a few housekeeping items first. Throughout the presentation, feel free to leave any questions you have in the Q&A box. These will be addressed at the end of the presentation, and we'll answer as many questions as we can in the time we have available. Second, this presentation is being recorded. A link of the recording will be sent in a follow-up email to all registrants, and it will be housed on the UMSL website for future reference. I'm honored to invite you to join us as we celebrate the ceremonial installation of Dr. Kristen Sobolik as the 8th Chancellor of the University of Missouri St. Louis on Friday, April 30th at 10:30 a.m. A formal invitation and link to register for this virtual event will be sent soon, so watch your inbox and please save the date. Finally, I wanted to share a few of UMSL's funding priorities with you this morning. First, scholarship. At UMSL, student success is our greatest commitment, especially in these difficult times. We certainly know that when financial barriers for UMSL students are lifted, they can enroll and stay enrolled in school through graduation. Scholarships fill the gaps of unmet need to become a lifeline for students looking to build better lives through education. That is why scholarships are a funding priority for UMSL. I hope you can join us for our 2021 Scholarship Recognition Luncheon on April 23rd. A link to register for that will be sent following this presentation as well. Second, the College of Nursing Simulation Lab. For 40 years, UMSL's College of Nursing has been an innovator and leader in the healthcare education in the St. Louis region. Simulation-based education increases competence and confidence, and skills gained in the simulation environment lead to better patient care. With current hospital nursing vacancy rates in the St. Louis region at 18.8% and expected to grow in the coming years, the college's efforts to re-envision nursing education is critical to delivering the nursing workforce that can meet our region's needs today and into the future. That is why the College of Nursing Simulation Lab is a funding priority for UMSL. Finally, last but not least, UMSL Accelerate. Did you know that St. Louis is second only to Silicon Valley as one of the top cities for startup businesses in the country? UMSL leads from the front in educating and fostering entrepreneurs in our region through UMSL Accelerate. Offering a new major in entrepreneurship, UMSL Accelerate will host a demo day tomorrow for the nation's first Diversity, Equity, and Inclusion Accelerator. It's really exciting, and we hope you can join us for that as well. A link to register will also be sent following our program this morning. Finally, the ultimate purpose of UMSL's Legacy Council is for you to consider remembering UMSL in your estate plans. Whether to perpetuate your annual gift or to create a legacy for what is important to you, it is through your planned gifts to UMSL that together we can continue to transform lives. Now, without further ado, I'm so pleased to introduce our speakers, Lyle Gilbertson and Paul Hilton. Lyle's real estate career spanned 35 years, including over 25 years with Turley Martin through its evolution to Cushman & Wakefield. Lyle was general manager of Westport Plaza for 19 years before transitioning to the firm's corporate services group, where he was responsible for our outsourced real estate teams for several clients, including Edward Jones, where he directed the team responsible for their 18,000 branch office network. Prior to his retirement in 2019, Lyle led the team responsible for the J.P. Morgan Trust and Estate real estate portfolio and had direct responsibility for leasing, management, and sales related to the J.P. Morgan Trust and Estate commercial properties in the New York City metro area. Lyle is a CPA and was with the international firm KPMG, Pete Marwick, Mitchell and Company. He's a graduate of UMSL, 1975, BSBA in accounting, and a member of the College of Business Finance Advisory Board and the UMSL Legacy Council. Paul Hilton is a partner in Burke Hill Real Estate LLC, a private real estate investment fund founded by Mark Burkhart and Paul. Burke Hill's most recent acquisition was the iconic 18-property Chesterfield portfolio representing one of the largest St. Louis real estate transactions in recent history, exceeding an overall investment of $100 million. Paul has been in the real estate business for more than 34 years. For the last 25 years, Paul was a capital market specialist with Turley Martin through its evolution to Cushman Wakefield. Paul has consulted with many of the major owners of the real estate across the United States on portfolio strategy, including acquisition, disposition, financing, and valuation of their properties. Paul's career transactions total over $8 billion. Lyle and Paul, we're thrilled to have you this morning. Thank you for being here. I'm going to turn it over to you.
Okay. Thank you, Sharon, and good morning, everyone. It's good to be with you. Let's get started with commercial real estate. When we set out on this presentation, we figured that many of you are coming from different ends of the spectrum. So we wanted to kind of lay the groundwork on commercial real estate firstly, and then dig into a few of the other buying and selling on the back end. So I'm going to cover investment property types, lease types, a little bit about investor considerations, market performance, as well as an outlook for 2021. And then Paul will narrow the focus and talk about the art of buying and valuing real estate, and also return expectations. And then we'll cover some Q&A, as Sharon said. So starting with investment property types, you see that there are a lot of alternatives, major categories of real estate, which we all know about, office, industrial, retail, apartment, multifamily, and even ground leases. The important thing here is to understand what kind of commitment you have from a management intensiveness standpoint. Clearly, multi-tenant office buildings or apartments are going to require much more day-to-day contact, not so much with a warehouse. Under industrial, you can see the different types. Certainly, bulk distribution is something we're going to spend some time on in a minute, because it's really a very hot market right now. Ground leases you may not know quite as much about. They do exist where owners lease their ground to a tenant who will then build a building, put the improvements on it. They're generally for long term, and at the end of the lease, the ground reverts back to ownership by the owner, and so do the improvements generally too. So moving ahead to lease types. Why is that important? Well, you have to know the responsibilities of your tenants. Lease types vary by property type. You know, who pays for what? And you need to know that, and you should do a thorough review of leases if you're looking at acquiring something, because oftentimes you might find a surprise hidden in the lease. As far as office leases go, generally they're full service leases, which means you know, the owners are paying for the initial costs involved with utilities and cleaning, taxes, insurance, and so forth. The tenants will pay a pro rata share of operating expense pass-throughs, which are over a base year, which is the landlord's previous year's cost. Industrial, though, can be a triple net lease. You've all heard of that. Fully net means the tenant, in addition to their rent, pays taxes, insurance, and maintenance. Retail can be either triple net, or it can be a modified lease where perhaps the tenant's paying its utilities, insurance, but maybe taxes are on a base year. So it can be either way. Fortunately for landlords and owners, on the next slide, you see that not all companies can buy or lease or buy or own their real estate. There are factors to consider. Companies like the flexibility sometimes, flexibility in terms of the term of the lease, ability to expand or contract or move. Also, their return on investment might be higher in the business operations. Also, rental payments are fully tax deductible. Until recently, many large-scale retail tenants kept these lease liabilities off of their books, but times are changing. New accounting standards now require what were previously operating leases to be capitalized. An example is Walgreens. With this new accounting standard, they've just put $22 billion of liabilities on the balance sheet. So instead of being relegated to a footnote, these are very transparent now, and in many cases, significant liabilities, which represents the present value of the remaining lease terms. There are considerations that investors need to think about. What's your time commitment? What's your expertise? Do you need to build a team around you that's going to help you with some of this? Depending on the type of property you buy, again, your time commitment, could be extensive. So your team would involve your lender for financing, which Paul's going to talk a little bit more about. It also could be an attorney to help you with the legal structure, with leases, or with other issues that come up, including loan documents. Depending on how many properties and what your time commitment is, you may need assistance with third-party management and or leasing. And then you have to look at, how am I going to own this property? Am I going to be the sole owner? Do you have the equity required to own it individually? Or are you going to take on partners? For many, a REIT is the answer, and that's a real estate investment trust. These trusts, many are publicly traded, allow you to invest a sum of money, and you usually would have a portfolio of properties, diversification amongst a group of properties, but you're delegating the decision-making, the management, everything to the REIT, and they're paying you a return on your investment. So something to consider. And yes, there is risk. As you'll see here in a minute on the next slide, there are risks to consider, like any investment, right? And these aren't all standalone. They're all interrelated. We're going to talk about vacancy, but we've seen what can happen with recessions or pandemics, inflation. Some of you may remember the 1980s when we had 20% prime rate. All of these could lead to some cash shortfalls. You need to put on a roof, you make your loan payments, put in a new tenant, and the message here, I think, is plan for it, put reserves aside when you have good years, build a cushion in so that you're not caught with having to put more money in, and perhaps you don't have access to that. There are benefits, and Paul's going to talk about those when he gets to his part. Next, I want to talk about market performance. And these slides that you're going to see starting with the next one here are provided to us by Cushman & Wakefield, the international firm that Paul and I both retired from. They track 50 million square feet of office inventory in the St. Louis region. And that ranks us 35th out of 87 markets that they track in terms of office size. At the end of 2020, overall vacancy was 14.1%. That compared to a year ago at 12%. And it compares to a national average of 17.7% for office. If you go down to the last item, negative 500,000 square feet of absorption. Essentially, net absorption is the change in occupancy year to year. So you have new product built that's not leased, and you have tenants move and vacate space. That detracts from absorption because the offset is new leasing. And clearly there was new product brought on the market and not enough new leasing during the pandemic. So it was negative absorption. Just stepping back for a minute though to talk about the St. Louis market overall. You know, of our top 15 or 20 employers, 53% of the employees are education and healthcare based, which is probably skewed somewhat higher than other markets like us, but that's thought to be a good thing. That employment tends to stick around longer term. And we're also obviously a hub for a number of financial services. So both of those are good. The education and healthcare is very active in the innovative market, the cortex, the bioscience fields, and those are thought to be very good areas for future growth of office occupancy. If you go to the next slide, we have interest rates. Rental rates shown here. You can kind of see here where in some years there was a slight downtick in the red here in rates, but these are face rates. Tenants don't pay the face rate. Landlords offer them incentives like free rent, and so they have an effective rate that's a little less. But they like to keep their face rates up because long term that's helps their building value. But then you see what's going on here in the past year, which is unprecedented, and that what we see here are some rates with new construction, particularly in the Clayton market, that we've never seen before in the mid 40s dollar range. So that increased asking rates by 7.3%. So kind of unprecedented and unusual. On the next slide, I want to show you what's been happening with vacancy rates, Class A, Class B. First, though, if you look to the right here, I mentioned Clayton market. This is really a tale of two markets. You have the West County market, which is the largest market in St. Louis, and then you have Clayton. You see the Clayton market added 500 basis points to its vacancy rate last year. That's a big jump. And the reason for that jump is the new construction that came on board and a very slow leasing period on top of that. And a lot of the new construction was not pre-leased, so vacant space. On the other hand, West County tends to be fairly stable. On this graph on the left, it kind of highlights something that goes on in real estate. The red line is your Class A space. And you can see when there's a decline here in vacancy, there's an opposite occurring, like in 2012, where an uptick in the Class B vacancy rates. Same way over here, you know, stable occupancy, if not coming down a little bit here, and then a blip where Class B increases. This is a flight to quality. Tenants tend to wait for things to go on sale, and then they, during a 2012 or 17 era, they see the opportunity to go to a higher quality building. Next, I want to talk a little bit about sublet inventory. And this is space that is under lease to a tenant, but they're not using it, or they feel they could give it up and move out if they could find another tenant for it. St. Louis area is looking at 1 million square feet right now of sublet inventory. The driver here obviously is tenants deciding that maybe they don't need some of this space. There were some mergers that played into this where tenants gave up space due to a merger acquisition. However, even if this 1 million square feet was added to our true vacancy, it would increase it by 200 basis points, which is still below the national average. It's not something that we panic over. It's definitely something to watch. And certainly if I was a landlord out there, I would be a little nervous that these tenants can undercut my rates. They can make me a better, as a new tenant, they could make a better deal on the space, maybe than the landlord's willing to offer. So something to watch, something to consider. It's definitely going to increase a little more this year as tenants decide what they're going to do. Next, I want to talk a little bit about market performance, and we'll talk about the industrial market here. The industrial market is made up of 255 million square feet of inventory in St. Louis, and that ranks 19th out of 80 markets that are tracked by Cushman. This is something that we mentioned earlier, very hot market right now for industrial. Vacancy at 5.3%. This is very interesting here. Deliveries, which is new construction, 4.1 million square feet last year, and almost 4 million square feet of new leasing absorption. So very impressive numbers. Next, we can kind of look at what the activity's been. On the next slide, yep. I want to point out, you can see a good amount of new building over the last 5 years. This is predominantly in that bulk warehouse. So these are large buildings, 250,000 square feet at a minimum, and a very healthy amount of new construction in that product class. Just the last 3 years, there's been 16.5 million square feet built, and the vacancy rate overall has declined 147 basis points. So I talk about a hot market. It's being driven by global supply chain management, logistics, companies wanting to be close to their customers. Indeed, on the next slide, you'll see more of where this is being built. I can tell you also who's occupying it. For example, Amazon, we all use them. They occupy more than 2 million square feet in the St. Louis market, and their providers, their service partners, occupy another 2 million square feet in St. Louis. As far as where it is, you see on the far right here, North County, Metro East, St. Charles County. Why? Well, these are areas where large tracts of affordable land are available. Zoning for industrial parks is available, and you have good interstate access, and you have rail generally as well, railroad. I'm going to touch very lightly next on retail, and I'm not going to spend a lot of time on the next slide. You all know a lot about this just by reading and observing. A couple points I want to make. Retail was struggling before the pandemic. There were store closures, consolidations, mergers, and just companies that left the marketplace. The pandemic, what really wasn't a level playing field for all of retail. Walgreens, Walmart, Target, those were deemed essential services and stayed open. We had several stops and starts with normal inline retail tenants, not just in malls, but in your neighborhood strip centers and so forth. So that's, certainly hurt them. CoStar reported over 12,000 retail store closings last year, a lot of it in the apparel and the soft good industry. The St. Louis properties, I just want to highlight two things to watch. Probably the biggest things that have gone on in retail in the St. Louis market in years, and that is a couple items in Chesterfield. Chesterfield Mall is being redeveloped, has a new owner. You'll see a lot of that be raised, and in its place, they'll be putting in high-rise, some office, some apartment, condo developments, and adding some retail in that will complement those uses. Chesterfield Valley Outlet Mall is now called the District, and it's next to Topgolf, and they're focused on entertainment, music, a food hall, restaurants, and so forth. As far as an outlook on retail performance, yeah, COVID-19 is going to have some further impacts, no doubt. Uh, Tenants did understand, though, that we like easy access, easy entry, drop off, pickup. So some of them are going to be looking to retain that feature. National tenants, some of them are going to slow their growth plans. We've seen a decline in tourism. Who knows what normal is going to be and when that will return? In St. Louis alone, leisure hospitality has lost 1/3 of its employment in the pandemic. E-commerce, though, it's here to stay. We know that. Its impact is being felt. Uh, it's hovering around 15% of sales. I'll show you that in a minute on the next slide. But look in general with retail for redevelopment and adaptation of vacant spaces. We've seen it with recreation, with volleyball courts being built. St. Luke's took a restaurant in the valley and made it into a medical urgent care. Aldi's took half of a vacant Kmart in Ellisville. So if you have a good location, retail's not dead. It's going to be around, and there's still good buying opportunities. You just need to price it right. You need to know your tenants, have a good location, and have a plan. This next slide shows you what has happened with the e-commerce. Really just in the last 5 years here, tripling from the 5% range to being 15% of sales. Retailers aren't giving up their stores as a result of this, though. What they're doing is rethinking their strategy. And it had started even before the pandemic. We know we can order online and pick it up in the store. That brick and mortar strategy has led retail tenants to, perhaps move some of their stores to better locations. More importantly, though, they've built warehouses closer to their stores so they can supply the stores with what's needed to be, what's ordered online and wants to be picked up. I want to talk for a few minutes about the investment market, the capital market in St. Louis. And indeed, St. Louis is seen as a stable, secure, safe market. We are a second-tier city, but many investors like to be here because we don't have the wild swings. We don't have overbuilding to the tune of other markets. In fact, on the next slide, you'll notice what we have in investment in the St. Louis market, fairly significant amount and fairly stable amount. What we've seen, though, is a change. The building blocks here show that industrial and apartment multifamily are leading the way as a percentage of the investment these days. Retail, we've talked about it. It's a little bit of a maybe waiting to see what's going to happen with some of this. On the office, I'd say it's more of a matter of the buyers and sellers can't quite get together on price yet. Sellers don't believe the pandemic's going to have, perhaps as dramatic effect as the buyers are. Buyers are a little nervous looking at the tenants. What are they going to do? So a little bit of a holding pattern there. You see that when they can't see eye to eye on what value is. But institutional money is out there. There's still a lot of money on the sidelines, and St. Louis is still a player for getting some of that. On a national scale, if you go ahead to the next slide, you'll notice what I just said, our 500,000 square feet of negative absorption looks pretty good compared to the rest of the 55 markets across the United States. Again, this is somewhat what overbuilding can do for you. Houston and Dallas and San Francisco. The tech market, I think I mentioned earlier, we're fortunate to be ag and pharma and bioscience, heavy concentration in that versus just regular tech, social media type platforms, because those office users probably aren't going to grow as fast as the science field. On the next slide, you see what's going on with industrial. And I just point out that these are increases in vacancy last year. And these are the markets that showed a decline in vacancy. But yet all of them have the black dots, which is new construction. So here, 28 million square feet, 14 million square feet, 6 million square feet. What this shows is the effect of speculative office building over here versus pre-leasing over here. Yes, even though these declined in vacancy, they still had new buildings coming online in the pipeline and being built, but there was pre-leasing here that offset some of the effects of the new product. Over here, you see the effects where spec leasing, caught them short, and they'll have to work out of it. And something to keep in mind, there's still a pipeline for building, so you can't turn it off. Next, I want to cover and wrap up with what's going on nationally. Cushman Wakefield has their market beat forecast, and this is a highlight, just a summary. Continued economic recovery in the office field, higher consumer confidence levels. Of course, office vacancy will probably blip up some, and rental rates will also correspondingly drop down a little bit. We'll see some decreases. But offline, my comments would be between employer and employee, there is Zoom fatigue. I think everybody wants to get back to some normalcy, but normalcy will really be some sort of hybrid model. Employees will come back to the office 2 or 3 days a week and probably work from home several days a week. Certain sectors of a business may go remote working completely, but there's still a need for tenants to have office space for recruiting, for clients, just for certain types of work that needs to be done, and for that collaboration. Surveys have shown, particularly the younger employees, really miss that collaboration that you can't have when you're working from home. On a national scale, the absorption that we've seen is going to continue. Yeah, there's a good pipeline of space, but that will cause vacancy rates maybe to, show some slight increase, low growth, and rental rates will begin to flatten out. But there's certainly good space to be had. And the other good thing for industrial is what's happening with data warehouses, the cloud computing, particularly what I mentioned before, that science field with pharma and ag and innovative centers like the Cortex. Companies across the globe are, hastening to clouds, and data centers has been very strong and will continue to be a player. So you can watch for that along with these bulk distribution warehouses to be the very hot commodity. So I'm going to wrap it up here and let Paul take it.
Thanks, Lyle. In about the next 10 minutes, I'm going to address two things for you. One is why, in general, people buy commercial real estate, and the second thing is how to determine what to pay for that real estate. And my first point here, it really depends on why you are buying. So different reasons come into play. Let's start with one: the investor. You can buy real estate as an investment, meaning you're looking for a return. And I'll go into specifics on these in just a second. You could buy it as a user, so you're buying it to actually put your business in. You can buy it as a combination. You can buy it to put your business in, but at the same time, maybe you have some extra space. You can lease it to an investment as an investment. You can buy it because you can and you want to, or you can buy it for tax purposes. So if you're buying it as an investor, what are the things that you're looking at? You're looking at risk-adjusted returns based on alternative investments, meaning if I can buy a treasury bond and let's just say it yields 3%, how does that look compared to buying real estate, which is typically illiquid and has risk? So one has to determine where their return expectation will be for the real estate they're buying based on what alternative investments are available. people are buying commercial real estate for appreciation. You're not buying for the value to go down, obviously. And investors buy real estate for portfolio, diversification, meaning if I have a large stock portfolio, I'm nervous about where that's going. I want to look at alternative investments such as real estate to diversify my personal real estate portfolio. When a user is buying real estate, they're looking at things differently. They're not looking at it from a pure investment return basis. And a user typically is in a position to pay a little bit more money for a property than an investor because they don't have to worry about risk associated with turnover. I have replacement costs here. What that means is, so if I have a manufacturing business and I need a building, I'm looking at that building from a standpoint of what does it cost me to build that building versus buy an existing building and improve it. And that's what's important to me because I need the business. I need my business in this building, and I'm typically owning it because I have to put a lot of money in that building to make it suitable for my use. From a user, location is also important. A user might buy in an area that perhaps an investor won't, simply because it's better for their business operation. Oops, sorry about that. Next type. So you could buy it as a combination of a user or an investor. So you could use a part of it for your business. And as I said earlier, you could lease it out and get a return. People do that because they want to have income, but people do that also to secure future growth space. You can buy as ego, and we definitely see that out there where, what do you pay? If you're an ego buyer, you pay what you want. It oftentimes doesn't come down to yield. It comes down to telling your friends that you own that real estate or driving up to it and feeling good about it because you own it. And finally, people buy commercial real estate for tax benefits. You can get depreciation, and I'm by far not a tax expert here, but you can buy it for depreciation. In real estate, you can do what's known as a 1031 exchange, which really defers the gain on a sale of property by trading into another property. And real estate has long-term capital gains tax rates that are lower than ordinary income taxes. I always caution people, as a side note, never buy real estate based on tax benefits because as tax codes change on a yearly basis. When you're valuing real estate, whether a user, investor, or buying it as an ego, what are some of the things that you should take in consideration? Location, micro and macro, what does that mean? So am I from a city standpoint or state standpoint, am I in a market that's growing or not growing? On a micro level, am I in a location within that market that's growing, stable, or declining? That is all going to play into the value of the real estate. What is the condition of property? Is it brand new, or do I have to put a lot of money into that property? What's the financing market like? Are the banks lending? Are the banks not lending? Are they, being very cautious or not being very cautious? That always affects the value of the real estate. What's the tenancy? If I'm buying real estate as an investor, is there a tenant? Do I need to re-tenant the property? Size of the deal. You have anywhere from private real estate investors to large institutions buying real estate. Typically, a large institution buying a very large asset are willing to sell for lower returns often than, say, a personal investor looking to invest some money for appreciation purposes. What's the demand in the marketplace? Are we, as Lyle showed you those charts earlier about the decline in the markets and really following the economy, and are you in a downturn or are you in an upturn? That affects the value. And zoning. So are you buying a property in a particular city or location that zoning is very difficult? So if, let's just say, for example, you're buying a fast food restaurant that's in a city that won't allow any more fast food restaurants. Well, if you're zoned for fast food, you're sitting on a very valuable piece of real estate because you have a lot of barriers to entry. And then the other, we talked about alternative investments. That has an effect on any type of property that you're buying. So now, rather than talk about user values and everything, we thought we'd focus just for a moment on, investor value and more specifically what they're looking at. And so value is ultimately determined by the return expectation, your return expectation. Return expectations are based on your individual goals. What do I mean by that? Why are you buying real estate? Are you buying real estate as an individual to build wealth? Meaning you want to buy something to add a lot of value to it so that, you can either sell it and retire or can take the income and retire. Or are you buying this because you want to sustain wealth? Perhaps you've had a successful business career. You've inherited a lot of money and you really don't need to take the risk to build the wealth. You just want to maintain the wealth. The yield requirements on those could be very different. Are you buying it for portfolio diversification purposes? Again, that's going to affect the value you're willing to pay for the property. And then finally, for the tax benefits, how do buying this real estate, some assets have greater depreciation than others. So are you buying it for tax purposes? I hope not, but if you are, you need to look at those tax benefits to determine what you're willing to pay for real estate. Thought I'd focus on, just to give people a sense for the complexities of real estate, focus on two examples that you could run into. So if I came to you and I said, I have a McDonald's ground lease that yields a going in return of 5%, or an office building that you can buy that the going in yield will be 20%, which one would you buy? My answer, have no idea. Why is that? I need more information. What do I need? Let's talk about the McDonald's ground lease. Things that I would need are the term. So is this a brand new McDonald's that has a 15-year lease that McDonald's credit's good and they're going to be there to pay you rent? Or is it a short-term lease and you have the risk of them leaving? What's the rental rate they're paying? Is it above market, below market? If they're paying way above market and they go out, are you gonna be able to duplicate that rent? How's that store doing? Is the sales volume, is that a good location, bad location? We talked about credit of the tenant. And then the value of the underlying real estate. If I have to tear down, if I buy a McDonald's and I have to tear down the building, what's the real estate worth? If I'm buying an office building, I have different questions. How many tenants are there? Is this a single tenant? Do I have 10 tenants? How many tenants do I have? Are there long-term leases, short-term leases? If I have short-term leases, I have exposure on turnover. So if I'm buying this office building that's yielding me 20% and I have two tenants and one of them vacates, suddenly your return is substantially impaired. Rental rates relative to market, the same with the ground lease. Are these tenants paying above market, below market? So if that 10,000 square foot tenant moves out, am I going to be able to increase my revenues, or do I risk losing revenues? Credit of the tenants. What are the overall market conditions? Is absorption strong, meaning that there are a lot of tenants that could replace the tenant that is leaving? Or is the market soft, that I might be sitting on vacancy for an extended period of time, which significantly impacts my return? What's the turnover risk? Are those tenants, do they have big investments in the space? Do they need to be there for a particular reason? Or are they going to move because they can get a better deal down the street? What are the building capital needs? Is the building in great shape? Do you need a roof? Do you need mechanical systems? All those can be very, very expensive. What are other methods of value in real estate? Sales comparison is one. You hear that if you ever had an appraisal, they like to show you sales comparisons. And in my career, I've always looked at sales comparison as simply a guide, because for two reasons. One, sales are looking in the rearview mirror instead of looking out the front windshield. And every sale is different. You could have two properties, identical buildings right next to each other, but if they have different tenancies, they're going to have different values. So sales comparison is a method, a guide, but I wouldn't use it personally as a a method to determine value. The cost approach really comes into play if you're a user, not so much if you're an investor. People will look at what the replacement cost is for an asset. We talked about that a little bit earlier with the user. Income approach is where you take the net operating income of a property and you apply your required rate of return on that property. You know, the caution I have is with the example of the ground lease, 5% versus 20%. I still couldn't tell you which way I would go on that, just simply because there's a lot of factors that will determine which of those two investments are a good investment. And we talked about the future rent increases. You know, on the income approach, are you below market, above market? That affects what you're willing to pay on an income basis. So my conclusion, you know, don't be fooled by going in returns. Things aren't always as they appear. There's a lot of factors that affect the value of real estate. And with that, I'll turn back over to you, Sharon.
Well, Paul, thank you so much. And thank you, Lyle. You both had a wonderful presentation and gave us a lot of information. And we've actually had some questions coming in as you were speaking, as well as some that were sent ahead of time. And we had several questions around loans and acquiring or applying for loans. And if you don't have 20% to put down, what you can do and what the best strategy is if you're a first-time commercial real estate purchaser to do to acquire your first loan.
So you want me to take that one?
That'd be great, Paul. Thanks.
So you know, from a lending standpoint or buying your first property, I would, a number of things come to mind. First off, I would say be careful when you are buying real estate and taking on loans. You're taking on significant obligations, and if you were to default on that loan, you're going to be responsible for that. And even if you were able to convince the bank to forgive the loan for whatever reason, Uncle Sam doesn't forgive the fact that you just were given free money. So there's often tax consequences associated with that. So my first thing is be careful. With respect to being able to buy your first property and raise money to be able to do that, you know, my experience is if you have a good asset and a good story and you can really understand and justify a good return, there are a lot of smaller investors wanting to buy real estate. And so, you know, early in my career, the way people got it done is you pass the hat, family and friends, and that's how you raise your initial equity. And you know, sometimes as the originator of the fund, you can take fees off of that. Sometimes you don't. If it's just your friends, you're doing it, you do it together. I will also caution you to be careful who you partner with, because you know, when things get tough, you really find out who your friends are.
That's great advice, Paul. Thanks a lot. That kind of leads into another question about kind of trust and how do you find a good commercial real estate broker, and what kind of questions do you ask them or do you look for when you're working with a broker and trying to understand what you need to about the property before you invest?
I can answer that one as well. I would say that my advice is to find somebody who is experienced in the asset type that you're looking to buy. You know, I'm in the commercial real estate business. I wouldn't try to represent you buying a house because, you know, that's just not my area of expertise. The business on investment real estate has evolved over the years to where people now specialize not only in selling investment property, but selling different types of investment property. So find somebody you can trust. Definitely check references. You know, there are people who don't necessarily look out for your best interest. So find somebody who has a reputation of looking out for your best interests. Those would be the biggest things I would suggest.
Great, thanks. Lyle, you might be able to answer this question from Charlie Hoffman, our former College of Business Dean. And he says there's a building boom in Clayton. Is this risky when everyone's working at home? What's happening in Clayton?
Well, certainly those landlords are going to have their work cut out for them. I think some numbers I heard was there's over 600,000 square feet of available space with, there's a Commerce Bank building, there's Centene, and they put some of their space on the market. There's two large tenants, a CPA firm and a law firm that are moving within Clayton. They're staying in Clayton, but they're giving up a third of their space as they move from within the Class A market to some of these newer buildings. So Clayton, I mentioned before, had a 4% vacancy rate and is double digits now. I don't know what the magic is going to be. I mean, you're talking about a market, Paul, maybe that at least 50 or 100,000 square feet of absorption per year, and you have 600,000 square feet. It's going to take a little while to work out of that. But most of the landlords are pretty well heeled, and I'm sure there's a good nucleus of tenants in their buildings right now, and people don't appear to be leaving that market. So it's not all gloom and doom, but it's definitely going to take some time, Paul.
Yeah, I 100% agree. I would maybe add that, good real estate is good real estate. And if you're, even in a downturn, if you are buying quality real estate, you have to obviously take in consideration longer periods of time where you have vacant space. You have to take in consideration additional capital costs to retrofit those spaces. But if you're confident in the location of the real estate and the quality of the real estate you're buying, it will come back. And quite frankly, there could be better buying opportunities for those who are willing to take on that additional risk, because there will be a lot of people who will want to sit on the sidelines.
Great, more good advice. Another question is here from Ellis, asking if now's the right time to start investing or if there's a better time in the market cycle. And you kind of answered that a little bit, Paul. But if you have anything more to add.
Yeah, I mean, I thought there was going to be a recession 5 years ago, and the market keeps going. And one of these years I will be right. I don't know which, but real estate is a cyclical business, so there are upsides. There are ups and downs. But with that said, I personally would buy in any market. It's all about buying the right property at the right price. And so there will be opportunities to buy in this marketplace, even though we're at, historical highs. But I caution, you have to be careful about what you're buying right now.
Okay, great. We're coming down to the last few questions. If someone, just to remind you, if someone does have a question, feel free to put it in the Q&A. But here's one from another Paul, and he asks, how and when can you recover passive losses?
Well,
Lyle,
I know
I'll defer to
there's a
you.
CPA behind my name, but I haven't kept up with the tax law on that there are restrictions, obviously, and you have to have, you're limited, obviously, and you got to have a certain amount of gains to offset it.
And Charles asks, how will rising interest rates affect commercial real estate?
I'm going to take that one, Lyle. So, if you're borrowing money and it costs you more to borrow it, you have to have a higher going in return in order to maintain the same return to you. So, rising interest rates will affect the value of real estate. I will tell you, in the short run, however, a lot of lenders have put a floor on what rate they were willing to loan you money. And until the treasury, usually a lot of times loans are based on where the treasury yields are. And until the treasury yields rise up enough to where you're hitting that floor, I don't see a huge effect. But if they continue to rise, it will definitely affect the value of real estate.
Great. Well, Lyle and Paul, you are both just outstanding. We're so honored and thrilled to have you spend your time with us and our UMSL audience here this morning talking about your knowledge of commercial real estate. We will be sending this link out to all the participants and those who registered who weren't able to join us this morning. Encourage you all to share this with your family and friends and take advantage of this UMSL knowledge. So Paul and Lyle and everybody who tuned in this morning, thank you so much. I hope you all can go out and enjoy this beautiful spring day.
Thank you. Thank you, Sharon.
Thank you.
Thank you.